Good afternoon, ladies and gentlemen, and welcome to the Business Day Dialogue live in partnership with RisCura. The theme for our event is Butterfly Effect from Kiev to the Karoo. My name is Nastasia Arnta, and I will be your host for today. As we all know, the world stands on the brink of one of the most significant crises yet as Russia continues its attack on Ukraine, and of course with the threat of a wider European war. Add that to other related significant pressures like the rise we're seeing in oil prices and increased global inflation. In the midst of the global crises, our speaker for today will share key insights on the Russia-Ukraine war, its effect on the regions, and of course, asset classes. We'll discuss some of the key issues affecting Africa. We'll bring it a little bit closer to home and look at South Africa, discuss the consequences, and suggest some possible solutions. We do encourage you to participate. If there's a question that pops up while our speaker is, of course, discussing and going through his presentation, you can type it out in the chat facility, and we'll get to those questions at the end of the presentation when we open the Q&A a little bit later on. So without much further ado, because there's lots to discuss, especially in this particular climate, I'd like to welcome Glenn Silverman. He is an investment strategist at RisCura. Before he comes onto the virtual platform, just a little bit about Glenn. He has over 30 years experience working in the global asset management industry, including diverse areas such as asset allocation, manager selection, investment process design, and corporate strategy. He has a particular interest in the BRICS, responsible investing, ESG, and other key investment topics, including megatrends and financial repression. So without much further ado, Glenn, the virtual floor is yours.
So thank you very much for the introduction. That's wonderful. I'm going to share my screen. So give me just 1 sec to do so. And just want to check that how that is coming up. We see that okay, anyone? Great. Okay. I presume you can see that okay. Great. So I thought maybe at the outset, maybe just one slide and a very quick introduction to RisCura, who are very well known in the institutional space, but actually not well known in the retail space at all. We have assets under advice and management of 2.5 trillion, so a very significant player. Company is about 22 years old. The head office is in Cape Town, 164 staff members. And as was mentioned a little bit earlier, I'm the investment strategist. I've actually only been at the company approaching 1 year now. So it's been a very exciting year for me. But just what we want to cover today, the butterfly effect from Kiev to the Karoo. I guess you can read into that already that this is a very interesting world. Small little things taking place far, far away are having enormous impact on a world that is very unusual and actually very scary. And I'm going to try go into a little bit of detail around that. So a little bit of backdrop, what does this butterfly effect even mean? Where does it come from? Talk about 5 key themes that I've identified, and then some unintended consequences that flow from those, focus on some wider risks out there, need to end off on a slightly more positive note with opportunities, and then I'll conclude in a single slide. So what is the butterfly effect? It's a term that comes from chaos theory, and it's a phenomenon whereby a minute localized change in a complex system can have a large effect elsewhere. And I've kind of bold and italicized minute because what we are seeing now is a very different situation. There's nothing minute about it. I'd like to describe it as a flying ostrich, and I know that ostriches do not fly, but this is a hell of a lot bigger than just a mere butterfly, however hard it may try to flap its wings. It's having an outsized impact across the globe, and South Africa and Africa is not immune to that. We'll talk about that a bit later, especially in a world which is so interwoven and highly interconnected. Stuff that happens far away, certainly we know, has a huge impact elsewhere. So what is really going on? This is not business as usual. Many argue that we're going through a global reset, an environment in which things look very, very, very different. And we can see that. So these are the 5 themes I've come up with. It's interesting that COVID, which has played such a major part of everything we're thinking about for the last 2 years, has kind of died down a little bit in terms of top of mind, but we do need to have a quick look at COVID-19 and what's happening there. Secondly, Russia, Ukraine, top of mind, certainly very interesting topic, and the implications for markets, for the world, for South Africa are very big. The global supply chain issues, which adds and feeds into the inflation woes we're seeing around the world, which leads to the central bank tightening we're seeing, are the 5 key themes, and then some very interesting unintended consequences thereof. So let's start with COVID. The good news is, as you can see in terms of daily new cases globally, have come down very, very sharply. I personally don't think we get another wave. If we do, not another significant wave, but even were we to get another wave, I think the response of governments and indeed populations would be different. I think we've learned something, not a hell of a lot over the last 2 years, and I'll reference that a bit later, but we've certainly learned, some of the consequences of lockdowns and the like. Obviously, the more important number is daily deaths, and we can see very pleasingly that those have come down quite sharply as well. So, COVID has impacted everything we spoke about over the last 2 years. What does that really mean? And in summary, the numbers are down globally, good news. Most countries have finally, and I think very wisely, decided to now live with COVID. And then in fact, it's those countries that try to have a zero COVID-19 policies that are the ones that are only hurting now, or are hurting now. The likes of Australia, New Zealand, in particular China. And China is taking a very aggressive zero COVID-19 stance. And I'm not sure exactly why, because firstly, that stance is pretty unsustainable. It's coming with enormous social costs. If you guys look on social media, you can have a look and see at some of the videos being posted about the intensity of the lockdown and some of the measures being taken and people being locked away. It's not very pleasant. And actually, it's an increasing risk to the Chinese Communist Party itself. And so I really do wonder, and many wonder, why they're taking such a strident tone. Is there something they know about this disease that we don't? I don't think so, but questions are asked. And yet, 2 years later, we still don't really know how it started. And so, the story is a bat flapping its wings, not a butterfly, in a wet market in Wuhan. We don't know the answer to that. And the debate still rages as to the efficacies of vaccines and masks and lockdowns. Thankfully, and I fly to the UK this evening, no requirements for vaccines, non-vaccines, PCR tests, etc. Certain countries like Sweden and others had long ago decided to take a more mundane approach, a more, I think, sensible approach to dealing with the disease. Russia, Ukraine, there are so many surprises. I mean, butterflies were flapping all over the show. Firstly, the fact that Russia invaded Ukraine at all. It was not expected. We understood there was some posturing taking place. Putin is called the master strategist, that he would get gains that he would need without having to invade. And yet in the end, he did invade. The second key surprise has been the exceptionally poor performance of the Russian armored force. I mean, that army is ranked as number 2 in the world. Ukraine sits 10 times positioned away, far away, position number 22 in the world. And you would have thought this would be a very quick war. That's certainly what Putin expected. And that hasn't gone his way at all. In fact, he's getting a bloody nose. And hence there's this ongoing threat of biological, chemical, and he threatens often, as the Russian generals do, the threat of nuclear warfare, which is terrifying. The third surprise has been the response of both Europe and NATO. I mean, NATO was pretty much felt like it was on its way out. And I think when Putin assessed this, he would have said the Europeans will not stand up to me at all, and he's been very wrong. It's been a very strong response. It's been a coordinated response. It's been a response which has, I think, strengthened NATO very dramatically, and I think that's the third and a positive surprise. And the fourth surprise to me has been the impact within Russia. The ruble, and I'll show you a slide a little bit later, that sold off very aggressively as the sanctions went into effect, has strengthened back to below the position beforehand. And so far it would appear that there's been a very limited impact on the Russian economy. Do recall, however, that in terms of Russia, what really counts for them are oil and gas. And obviously oil and gas prices have gone enormously higher. And so there has been that positive feed through to the economy, but I still sense that bad news is on the way for Russia. So the master strategist has made a big and very, very costly error. It's interesting because I think he's ex ante, his before assessment of what was going to happen would have made a lot of sense, at least to him. You know, he knew that oil prices would go up, benefits him. He thought the Europeans would not be able to stand up against him. He thought the war would be over in 3 days, or certainly would take Kiev in 3 days. None of that happened. It all backfired on him. And things are unlikely to ever be the same again. We're in a very different world. So how it started was bravado. It's going to take 3 days. And what's happened is he lost massive parts of the army that he assembled. In certain cases, 2/3 of his tanks have been destroyed or in fact captured. I think 300 of them are now fighting for the Ukrainian side, etc., etc. It's not gone at all well. My second surprise was this one. There's a graph of the ruble. You can see that massive sell-off as the sanctions are imposed and announced and imposed, and yet the ruble has strengthened very significantly. Against that, on the right-hand side, the cost of insuring against Russian default, in other words, credit default swaps, has gone to a very high level, an expectation that Russia will indeed default. And some of that is kind of a technical default. I mean, it's got very strong reserves. It's got dollar assets, but it can't access those because of the sanctions imposed. On the right-hand side, this graph actually has started to come down slightly of late, but nevertheless, clearly 2 extreme sell-offs. But the surprise to me is how much the ruble has strengthened. And one can postulate a bit around that. Obviously, oil and gas prices going up has supported the economy, but they've also effectively moved to a gold standard. And they have massive holdings of gold, which may too have helped to stabilize the ruble. There's been some wonderful tweets, and I'm following Twitter more than I ever have before. And just because it's a wonderful source of information, factual, sometimes not factual, but I love this guy. His name is, he called himself Darth Putin. And he says the following, and I track him often. This is day 61 of my 3-day war. I lost a dozen generals. I lost the French election, a flagship, and more than 20,000 soldiers. It is going according to plan. I remain a master strategist. Obviously, a very tongue-in-cheek assessment of the situation. So what are the implications of this? Is World War III now underway? And unfortunately, the absolute conclusion is yes, it is. Now, it may have moved from a Cold War into a much warmer war. There's discussion about the concept of a gray war. And we've seen that gray war already fight out in the second line. Trade wars, cyber wars, social media wars, sanctions. These are forms of warfare at the end of the day. There's also a proxy war being fought where Ukraine is obviously being supported heavily by NATO. And you know, Putin often references that. And the question is, can that move to a hot war? Well, it's a very, very extremely hot war in the Ukrainian kind of context, but does it move wide? And we pray not, but who knows? There's so many possible outcomes of this. Could Ukraine be defeated? I'm betting not. I'm hoping not. Could it lead to the defeat of Russia? And what does that even mean? Does that lead to the demise of Putin? And there is talk of, you know, possibility of a coup or him being, you know, overthrown, etc., etc. Unusual because until very recently, extremely powerful position, but he's gone into his bunker underground and is hidden away there. And the next question you have to ask is, would the next Russian leader be any better? Because it's not clear that he would be. There's clearly a very significant geopolitical realignment taking place. The most important is obviously China. It's the biggest population in the world's second largest economy. What happens in China really has huge impact, in many ways, much more than Russia, which is a very small economy, a large country, but small population, small economy. You know, China's relationship with the West and with Russia, how it decides to play that out. China has threatened often that it will attack Taiwan and that it wants Taiwan back as, you know, under its control. I think what's manifest now, because of what's happened with Russia and Ukraine and how badly it's gone for Russia, the likelihood of that taking place is much reduced. And obviously, I think that's very good news. And then remember, India, which currently is the second largest population in the world, but soon to be the number one. What it decides to do is very, very interesting, needs to be watched closely, and there are other, and I'll reference that a bit later. But other things have happened as well. For example, insurance premiums have gone up sharply. Now, that doesn't sound like a very big deal, but it is a big deal. For example, you want to send your ships off to pick up wheat that's being supplied by Ukraine, etc. Or going to Russia, in fact, you cannot get insurance premiums if you're going to Russia, etc. You know, the embargoes have prevented that. Actually, you can't get in at all. and then to the oligarchs who, have become enormously wealthy, often because they supported Putin and therefore Putin kind of supported them. There was this synergistic kind of relationship between them, symbiotic, if you like. Well, they've lost some of their fancy Western properties and some of the super yachts. An announcement yesterday that Putin's own personal yacht worth only $700 million has been confiscated. That was my second theme. The third would have to be global supply chains. And the problem is the supply chains in the world were already pretty snarled up from COVID-19, lockdowns, etc., creating a real mess out there. But obviously the war has impacted very significantly. In a world which is globally interconnected, I need to buy a new car at a point in time. You cannot get a new or old car actually in South Africa. There's a huge shortage. It may just be a memory chip. It may be a piece of wire. It may be the leather. It may be any part. But if it's in the global supply chain and you cannot get it, you can't get the car. And so that's going to have enormous implications down the line. Firstly, shortages. In other words, there'll be certain stuff that soon you just won't be able to get. It won't be available. And obviously, as things maybe become entirely short, high inflation leads to higher prices. Already there are shortages in some very critical areas. We mentioned oil and gas, and I'll talk about Germany a bit later. Fertilizer, so important, the starting point of kind of food production, food itself. The likes of Ukraine is enormously powerful and a rich country, a major supply of wheat, sunflower oil, and other, and obviously those are being severely damaged. There may be, extreme shortages of those going forward. And just to add insult to injury, we now have bird flu out there as well. Reports are that 37.5 million poultry, chicken and the like, have had to be destroyed in the United States of America alone in the past few months. So kind of a bit hidden away and one doesn't see that, but there's stuff happening out of there which is kind of problematic. And I think that leads to an increased demand for self-sufficiencies. Countries are saying we actually need to look after ourselves first. We already saw that a little bit under COVID, kind of there's COVID nationalism, and people said we'll first look after our own people before we look after others, but we're going to see that in food and other areas as well. People have argued that globalization peaked some time ago, and it seems to be the case. All of this, I think, adds to the sense of, we globalize less, be more self-sufficient. We need to have internal resources. And then obviously there's an increasing risk to social stability globally. When food prices go up, you have Arab Springs. And I think the risk of more Arab Springs taking place is obviously increased dramatically. And I think it's a very real risk, especially in places like, for example, North Africa. Egypt gets 100% of its wheat from Ukraine. Well, they're not going to be getting much wheat going forward. And already prices have gone up substantially and pressure on governments to try to subsidize those. Here's just three different graphs of fertilizer prices in different parts of the United States of America. I look at charts like this, you can say these are not just unusual. This is 3 standard deviation events. See North American fertilizer price go from $200 all the way up to $1,200. That's a 6-fold increase. It's an unusual, it's exceptionally unusual. Again, I say the butterfly is flapping its wings very, very hard. Look at this graph here. These are ships waiting to load or discharge their goods at Shanghai. We've got a series going back to 2017, and you can see the red line towards the beginning hitting that 300 level mark. Again, it's beyond unusual. This is off the Richter scale. You can see, and this is happening across the board. I'll give you more examples a bit later. So, so we have an issue with supply chains, and obviously that feeds into the whole inflation discussion. Now, the world has been in a very, very good place for kind of 3 decades. It's been in a deflationary phase for a long period of time, which allowed, because inflation kept falling, interest rates could be cut lower and lower, which means the discount rate that you apply to an investment or a project has been falling too, which led to both a rise in speculative activity, but also a rise in asset prices across the board. Property, bonds, equities, art, motor, it didn't matter. Lower inflation, lower interest rates mean your discount rate falls and therefore your asset price rise. But it is now clear, even to the Fed, who seems to be very surprised by what's happened, even though everyone out there has really been saying would come, that inflation is not transitory. This whole concept of the modern monetary theory experiment, I would argue, is now effectively over. So the thought that you can just print money and cut interest rates to zero and in fact negative with no consequence whatsoever has now proven not to be the case. Thankfully, I think we hopefully return to some kind of normality. But inflation is a much wider issue than simply higher oil. So if I take the United States of America, we mentioned supply chain issues, food issues. So the shortage of supply, by definition, that would increase prices. Then we had COVID and the stimulus checks that were issued, which led to consumption and increased demand. Shortage supply, increased demand, both of those lead to higher prices. And then finally, in the States, dramatic shortage of labor. They're talking about just massive numbers of people resigning from their jobs and moving on, etc. We're seeing wages going up substantially, bonuses having to be paid to people to join a McDonald's because they just can't get staff members in. There's a shortage of staff. And there's now increased unionization because I think for a long period of time, kind of shareholders and management and the corporates made, all the money and the pie that was going to labor was very, very low. All of those are very, very inflationary. And so inflation expectations, I believe, are now very deeply embedded and increasingly unanchored. We're in a world that we haven't seen for 3 decades, and it really is a problem, especially in the West. Inflation issues and numbers, China came out with inflation numbers this morning. They've gone up from 1% to 2%, but they're not the numbers we're seeing in the West. But that's creating a real problem for central bankers who have really enjoyed the environment of looking like heroes. Now, when anything goes wrong, we cut interest rates and we flood the system with money, and that worked really well until inflation came to the fore, and not just to the fore, the 3 standard deviation type of numbers. And so central bankers in the West are now between a rock and a hard place, and I really do believe it's largely of their own making. And so the concept of financial repression that I've presented on before comes to the fore. The fact that we have negative real interest rates is very, very problematic. The fact that you can't really leave money in cash, which actually is a very good performing asset at this very juncture now, because you're going to get a zero return or a negative return or a very low return, is problematic. And it's likely to be here for a long period of time, even if American inflation, which just printed at 8.3%, ahead of expectations, falls to half that number because of base effects, 4%. It's expected that US interest rates only go up to 3.5%. So even then, you'll be sitting with a negative real interest rate and a continuation of financial repression. Let's have a look. I've spoken to this already, but here's a graph to show the numbers. United States inflation going back to 1970. You can see that 1980, we had the same thing happened. Oil prices went up very, very substantially. US inflation gets up to 15%. But there was a head of the Fed then, Paul Volcker, who was prepared to take some tough medicine. He raised US interest rates, short-term interest rates, to 20%. Can you imagine? We can't get to 3.5%. In fact, the market's struggling with a 1% interest rate. He raised it to 20%. He knocked America into recession, but he also broke the back of inflation. And the benefit of that was 30 years of very, very low inflation, a disinflation period until very recently. And again, the numbers we're seeing now are unusual. It's a 3 standard deviation type event. I thought this kind of demonstrated fairly well, because here's German CPI in the dark navy, and in the orange color, German PPI numbers. Again, that's off the Richter scale. And I use Germany specifically because remember that for Germany, inflation is a national scar. They suffered through hyperinflation in the 1930s. In the same way they said we'll never have a Second World War genocide ever again, we will never have hyperinflation again. And to print a PPI number of some 30% is extremely, extremely concerning for them. And remember that has 2 implications when PPI is so high. Either that inflation, the blue line, the CPI number, the inflation number, the retail inflation number catches up to that, or that is because corporates kind of push those price increases onto consumers, or they take the knock, which means that corporate profit margins have to fall, and that too is obviously problematic for markets. So as a consequence of that, we have interest rates now rising across the globe. And it's happening at a time when debt levels are at record highs. For many corporates, especially in the United States of America, there's many companies they call zombie companies that actually could not survive but for the fact that interest rates have been zero or below. And then many governments in the West, the United States, the ECB, but in fact, China as well, have very heightened levels of debt. At a time when we have very high inflation in the West, at a time when economic growth was already slowing and set to slow further, and as interest rates go up, growth will slow further, and now war in Eastern Europe as well. And so little wonder then that fear prevails. So we've seen markets down very sharply in the first 5 months of this year. So we're in a risk-off type of situation pretty much across every asset class. Every asset class benefited from the opposite, lower inflation, lower interest rates, and every asset class is being kind of sold off as a consequence of the opposite taking place. But the most overextended areas are the ones that have been punished the most: the zombie companies, tech shares, growth shares, SPACs. There's this fund in the United States called the ARK, cyber, crypto, currencies, etc., etc. There's a graph, a form of debt. This is kind of total margin debt in the United States of America. So this is speculative debt, and you can see how after each crisis, those debt levels like 2000 started to fall down, but then the Fed stepped in and cut interest rates and flooded the system with money, and so debt levels, margin debt levels went up and up. And you can see until very recently, record high levels, now fallen slightly, and I expect this to continue to fall further as interest rates in the United States of America go up, which they're going to have to do. We'll talk about that a little bit later. So, a difficult environment, and certainly with margin and other debt very high, I expect to see that come down over time. In terms of the market sell-off, here's a chart going back some 50 years. In the orange line, we have kind of the pullback that takes place in the global Barclays aggregate, so the bond market. And the blue line would be the S&P 500, so the largest measure of the United States equity market. You can see some very, very sharp falls at different periods of time. We've got off to a hell of a bad quarter. So the numbers when this chart was produced had bonds down 11%. Well, those hit a 15% drawdown as of a few days ago, when the United States kind of bonds went to 317 on the 10-year bond. And in fact, the United States equity market, which was down 13% by then, from peak to trough, from the best to the worst position, down some 18%. Now, not nearly as bad as the 30, 45, 51, and 20%. It's the fifth worst fall, but nevertheless, a very traumatic quarter or half of the year that's just taken place. And then with all of that taking place, other stuff has happened, stuff that we didn't expect, unexpected stuff, some unintended consequences. So I start with an example of Germany. Germany, because of its desire to be more green, etc., decided to close all its nuclear plants by the end of this year and stop all coal mining, and therefore to become entirely dependent, or almost entirely dependent, aside from renewable energy, etc., on Russian oil and gas. There was an intentional strategy. Actually, with Russia part of the world and a huge supply of oil and gas, and actually quite close to Germany, made a lot of sense. And then we had the Ukraine invasion. Now all of a sudden Germany is short of power. If they buy more oil and gas from Russia, they're effectively supporting the Russian war efforts and everything that comes of it. That's clearly unintentional. And so there's a major challenge now to Germany to reduce their dependency on Russia and establish new supply lines, and to this new German government not to get voted out at the same time, because you could cut off all Russian suppliers, be short of energy and have blackouts, a bit like we have in South Africa, etc., probably not going to get voted in again. So, the move to this green world, the ESG, which I'm very supportive of, has had some very unexpected and unintended consequences, which have actually accentuated the problem. That was not expected. Example number 2, continuing a theme a bit more broadly. An unintended consequence of ESG has been rising fossil fuel prices, which kind of, what we wanted was to do away with fossil fuels and actually have those prices fall, but it's done exactly the opposite, because access to capital in the sector is now extremely limited. So we've got limited competition. It's driven up commodity prices, which have driven up earnings and share prices, and hence it's become the best performing part of the market quite perversely. And I'll give you a South African example in a slide coming up. Who's going to benefit next? How about our manufacturers? From an ESG perspective, probably not the part of the market you want to be doing the best. And yet we've got a massive war on, massive supply of armaments coming from the West, etc. And that's going to provide a big boost to profits, quite sadly. So clearly, I would argue that a butterfly somewhere is flapping its wings, or maybe it's I don't know what they are, when a whole swarm of butterflies really, really hard. So here's Thungela's resource share price. This used to be part of Anglo American, which was unbundled only a year or so ago. It was unbundled, the share came onto market around 2 Rand, and in the last year alone has gone up from 2 Rand to 19 Rand. I mean, that's almost a 10-fold increase in a mere 12 months. As I say, one of the best performing shares on the entire stock market. Unintended, probably in most cases, unexpected. Third example for China. Now, this is, I have mixed views when it comes to China often, but maybe the war in Ukraine actually has some possible positive outcomes for China versus many other places. Firstly, Russia is more dependent on China than ever because it can't trade with the West now, sanctions and others. The Chinese are getting apparently very large discounts on purchase of oil and gas, anything up to about a 20% discount, so that helps them. I think the likelihood of them attacking Taiwan has dramatically reduced, which is good news. They've built up massive food stockpiles. So China has the biggest supply, or the biggest reserves of any country in the world, and you can't just put that all into US dollars. So that they've gone and put it into different stuff, including commodities, including food. So that's going to stand them in good stead. China's already suffered 2 quite significant corrections in the last shortish period of time. The stock market is already down sharply, as is their property market. That means that some of the pain, or maybe perhaps most of the pain, has in fact been taken. And unlike, for example, the United States of America, that has to raise interest rates now because of this very heightened inflation, they can probably cut interest rates, and probably will do in China, and they've got some fiscal space as well. So this is an opportunity which I probably didn't expect and wouldn't have expected, but it's another unintended consequence of kind of what's happening. I would argue that maybe time to start building a direct Chinese position. The fourth and final example I want to use is demography and demographics. They often say that demographics is destiny, but it's a very slow burn force. I'm not sure if you're aware of the fact that Russia has an aging and declining population. In a few years' time, and certainly a decade's time, it will not be a superpower anymore, irrespective of what they do with their army. They just will have too few people. And I do wonder a little bit whether that might partially explain the timing of the Ukraine attack. Whilst you're strong and big, and you've got 110 odd million people in the country, you can still, and I think the number slightly higher than that, maybe now is, he thought, the time to attack. I mean, the same issue applies to China, world's largest population, 1.3 billion, but it too is aging very rapidly and starting to decline, potentially very rapidly so. I mean, I've seen some stats that say that China in 20 years could have half the population it has now. You're not quite the force with 500 million people, for example, than you would at 1.3 billion. Obviously, China's on the other side of, India is on the other side of it as it takes over that world #1 position with its own implications. And India, we're going to have to watch very, very closely because, it's situated in quite an interesting part of the world in Asia, next to Russia, next to China, etc. It is a democracy allied to the West, but also has played this very interestingly in terms of kind of, what it's been doing with Russia. And, it's tried to stay fairly neutral, I guess, which I guess is probably fairly sensible. And the other place that has a fast growing population and hence a huge opportunity, but with it risk too, if you can't employ that part, is Africa itself, and we'll chat to Africa in a sec. So in terms of implications, I've already said that what is taking place has meant that we're in a risk-off environment. Risk on, you want to be in the assets, in the markets, etc. Risk off, the exact opposite. There are big risks there. I think we've spoken about the war. I mean, what happens if Russia does win the war? They've already made it fairly clear that Ukraine is not the end target. I mean, NATO is an issue, and Poland and others could be next targets, etc. Or Russia loses the war and then decide to go unconventional warfare. They sit with something like 2,000 tactical nuclear weapons, bombs. That's just a very, very scary thought at the end of the day. What happens if China errs and instead of kind of joining the goodies, joins the baddies? the continuation of the zero COVID-19 policy, this very tight shutdown, etc., does create its own problems, etc. What about the implications of what's taking place here for North Korea, Iran, other countries that are big and powerful, and many of them, certainly North Korea, have many nuclear weapons as well. And then kind of global politics, even within the United States of America, never more polarized, never more difficult, pretty ugly all told. Does that get worse? And then for markets, the risk would be that inflation remains elevated, that the Fed raises rates either too much or too fast, that the US and Europe slow further. Some would argue that they're already possibly or potentially in recession. They would certainly get worse if interest rates were heightened and hiked further. And with that would come earnings risk, a higher risk of defaults, and therefore more challenges to the stock market. In terms of risks of this scenario and these butterflies flapping its wings to Africa, where Africa would get less focus and attention, there'd be less cash and less inward investment. Food inflation, insecurity, kind of the Arab Spring type of risk would be a concern. Already climate change is impacting the continent, it's impacting the world clearly, but having some big negative impact. What about Russia? Russia is very involved in Africa, actually in a very negative way, sending the Wagner Group and kind of the mercenaries and arms and etc. Possibly Russia losing a lot of its armament and being less focused. Maybe it means Russia's involvement has less. And then how does Africa choose to align itself? Does it make mistakes in how it does that? And obviously, to the extent that global rates continue to go higher, it does portend the possibility of currency risk, default risks. There's one or two countries in Africa kind of suffering some of that. Egypt recently had a very sharp move up in the currency, and a weakening of the currency, etc. Zambia and others, discussing how they might sort out higher risk, higher debt levels and the likes. And then for South Africa, we have some challenges as well. Firstly, we're part of the BRICS, Brazil, Russia, India, China, and South Africa. Not necessarily the nicest group, boys, especially since that Russia is kind of, that's a territory you shouldn't be aligned with at all. And so we've seen South Africa get itself into trouble recently in terms of United Nations votes and who to vote for and against and how to abstain. And so this is increasingly problematic. In terms of food, thank God South Africa is actually fairly self-sufficient when it comes to food. Thank God we have farms and farmers out there. But this too would obviously be a concern as well. And we've seen inflation pick up and continue. The central bank in South Africa, the Reserve Bank has continued to raise interest rates, I think very appropriately, very slowly, very consistently, but we do see that moving up as well. And that tends to be slightly negative for markets and economic activity. The risk of, July unrest, xenophobia clearly is something taking place out there with Operation Dudula, lots of court cases and corruption cases. There's a lot of stuff happening out there. Eskom, we live through it, having some real challenges. Not only are they struggling to supply electricity, but De Ruyter talks about the fact that there's stuff taking place within the organization is very problematic, almost internal terrorism and sabotage taking place, which as they kind of sort the one out, he says something comes, the other side. And then we know that climate change too, like for Africa, will be problematic for South Africa. Global warming, South Africa is expected to warm twice the global average. That's just the science of it, which is problematic. Recently, after COP26, South Africa was promised $8.5 billion, almost 130 billion rand. Might that be at risk if money has to be channeled to other places, to Ukraine to rebuild, et cetera, et cetera? We hope not, but I'm highlighting the risks, and obviously these may not come to the fore, and hopefully they don't, but kind of worth assessing. Then there are opportunities too, thankfully. So if I start with Africa, including South Africa, first in terms of geopolitics, I think it is wise to say somewhat neutral, provided we're on the right side of both morality and history, because it could come back to bite us if done incorrectly. Anything to do with green, renewable energy must be an enormous opportunity. We had one of the best REAP programs in the entire globe. It then got aborted somewhat. That needs to come back to the fore, and money is waiting to invest in that particular area. Agriculture, food, what an unbelievable opportunity. So farmers had to have a tough time, and always do, attacks on farms and bad weather conditions, etc., but actually sits in quite a powerful position. And again, the fact that we're almost self-sufficient in food supply is really important. And then investing into the real economy, because if the stock market is going to continue to struggle for a while as inflation and interest rates go up, what about the real economy? What is called impact investing, private equity? Lots of opportunity there, and RisCura are kind of launching stuff in that space that we think will be opportune, that will be attractive. In terms of South Africa specifically, well, the first good news is we're quite far from the bad action. The discussion with my wife, she says, well, if there's nuclear warfare in the northern hemisphere, we're not really impacted. But obviously, we'll take the wins only a short period of time before we are impacted. We really don't want that, but we are far away from the action, which often is bad because, it's a long-haul destination. So if you want tourists to come, it's far. And so, it's expensive for them to do so, but being further away from what's taking place currently is very good. I think we could become a safe haven, and certainly a safer haven. It's a relative game. So if you're looking at investing in different areas, why not South Africa, which is far from the action? Why not come here and put here rather, provided crime is reduced? How about a safe haven from financial repression? If we have real interest rates, a less oppressive regulatory environment, less red tape, companies will be looking to move here. And I think that offers a wonderful opportunity. We obviously do need to reduce corruption, ease doing business, make sure and explain clearly that we're open for investment. But since we've messed some stuff up over the period of time, this actually is a great opportunity. I look at, for example, the World Economic Forum, and South Africa's ranking their global competitors, and we've fallen so sharp in certain areas. For example, labor relations, and for example, around stuff like corruption. We sit as the education, the worst in the world. So actually to go from the worst in the world to the 5th worst in the world or the 10th worst in the world is actually easily done, I would argue, and so an opportunity. And then in conclusion, we're experiencing extreme volatility. These sell-offs are taking place, and it's not pleasant if you're invested, but they provide opportunities. Asset allocation is always important. It's the most important single decision you can make is how much into equities and bonds and cash and property and the likes, and even more so in these conditions. China, for the first time to me in a long period of time, looks really interesting. So I think that's worth thinking about. And Africa and South Africa likewise, provided we don't squander the opportunity. And so we do need to make it easy and attractive. And Africa more broadly, of course, it's higher risk, but with that comes higher reward. It requires more effort, but the potential rewards, I believe, are great. And again, RisCura is very active in the African space and looking to launch some interesting and exciting products in that space too. In conclusion, as I started my presentation, it's just no longer business as usual. Events far, far, far away are having a very direct and material impact on markets, on economics, on sentiment, on fuel prices, on food supply, on inflation. And so, as I say, butterfly wings are flapping a lot, and we need to be very aware of what's going on there. We need to be fairly sensible. I think we also need to be prudent and careful, and I think patience is important. In an environment of interest rates moving up, it's the time to reduce risk and be a bit more cautious. In an environment like that, actually cash is quite an attractive asset, not for the long term, when inflation kind of sticks around, but during that, because the return of capital, I would argue, is as important as return on capital. Currently, if you're getting 0 or a very low rate in cash, it's been better than often equity markets going back 15% or US bond markets doing the same. Seek out the opportunities. I've listed a few. There are others. There are many, especially in kind of South Africa, where I think there's always opportunity. We're a fast-growing emerging market, or should be a fast-growing emerging market. There are opportunities, and out of all of this, another buying opportunity is building. So US market down almost 20%, in the first few months of this year. A bit of a rally yesterday. I don't know if that will hold, but as we come out of this, things that are down 20 and 40 and 60 and 80%, and there are many of those, are things that we need to start looking at. So actually, whilst it's been a very difficult environment, that does mean a very wonderful buying opportunity, or potentially so. I thank you for your time. I'm going to stop sharing my screen, and we're going to move over to questions.
All right. Thank you for the very informative presentation. So apart from, obviously listening to you and, you quoting that you US inflation print, I took the liberty to have a look at how the markets are performing following that, but also to try and help you answer your question, where we were trying to figure out what a group of butterflies flapping at the same time could possibly be. I may not have a name for that, but I do know that a group of butterflies, according to Google, is a kaleidoscope. Sounds a lot nicer than a bit of the picture that was painted, especially when it comes to the risks, but I'm sure we'll find another name. So while you were delivering your presentation, there were some questions that have come through. So thank you so much to those of you who posted your questions. If there's any other questions that you do have, now is that opportunity where we have Glenn in the hot seat, so to speak, and he'll be able to tackle those for us. So the first question reads here, and I know that you touched a little bit on this, but perhaps this particular listener missed it. Let's reiterate that point. And here she wants to know which countries or economies or perhaps sectors are already or likely to benefit from the Ukraine-Russia war.
Yeah, it's an interesting question. It's a good question. I think at this point in time, my natural tendency, but I tend to see the glass half empty always, is to focus on risk. And so I think my first focus would be protection of capital and how one does that. And then one starts to look for opportunity. As I say, there might be sectors. I mean, this happened so strongly in the COVID sell-off that took place. Certain sectors looked like they got sold off so aggressively because of an expectation of what COVID would do. And then just a few months later, because of a sense that there was, borders would open again, those same shares rallied. So I think I'd be quite cautious of taking too shorter-term view on these things. I would have a very strong long-term preference for each of the following. Quality, always. Valuations, very important. I don't like paying up for stuff. You pay up for stuff, you take big risk. And we've seen that so evidenced in the last few months. Again, cryptocurrency is just an example of that. But wow, I mean, the sell-offs have been very, very extreme and we felt it. If there is a yield, a sustainable yield, that gives you the ability to withstand some capital, outflows, etc. So in the short term, oil and gas, food, anything related to those type of aspects. As we open from COVID, so, tourism and transportation looked a hell of a lot better. Now suddenly there's a war again and there may be some risk out there, plus oil prices hurt airline profits. So I'm not a stock selector or industry selector anymore. I used to do that. I'm not going to be drawn much more on those. I think it's just too short term. And you could say something this week and then, 20% lower, something unattractive, I think becomes very attractive. And we've seen that level of volatility. So I think, do your work, pick a share or sector that you do like. If it gets to your target level and you've done the work, take it.
On that note, then the next question says, does one still think strategic asset allocation based investment or the investment landscape has changed, i.e. going through structural changes?
Yeah, I think it's a very good question. There's this difficulty of knowing what strategic, medium-term, dynamic or tactical in terms of changes to asset allocation is an interesting debate. I mean, for 20 years, almost 30 years, as we had disinflation and interest rates came down, you could pretty much stay in the same position. Now, I'm saying we have a global reset. I think we have a very difficult phase we're going through. And so, if it's now back to an inflation of an environment of heightened inflation, I think you do have to relook at your strategic asset allocation. For 30 years, cash was trash. And now for 3 months, cash is king. So I think that you did ask stuff. Now, again, we want to take a longer term view. That's very much a quarterly type of analysis. And, RisCura runs some very detailed and sophisticated asset liability models, but that's not available to the retail investor. Have a thought about your risk profile. Think about a slightly different environment. Do remember that post-COVID, the South African market is up hugely. Some pullback is not the worst idea. It does provide, opportunity to go back in again.
And the other question says, any views on stock-specific investment holdings in Russia and the right principles of investing from an ESG perspective? Either sell, and if so, to who? Or do you hold as for sale, and some of the social obligations to Russian people?
Yeah, that's a wonderful question. It's very interesting. Obviously, for a period of time, as sanctions were imposed, the Russian stock market closed. I don't remember, it was a week or 10 days or something like that. And the Russian, for example, stocks have been taken out of global indices. And so global indices now sit ex-Russia. They've been excluded. You know, some people have said that's an unbelievable opportunity to buy very, very cheap Russian assets, you know, that are no longer in the index, etc. And it does fit there. Against that is obviously you don't want to be supporting, you know, the Russian war effort in any way. And so, you know, I commend Germany making a decision to say we're going to reduce our purchase of oil and gas, even though we'll take some pain. Admittedly, they've also been having discussions with many others as to how to replace that so that you don't have as much pain. So from an ESG perspective, I think real questions are being asked. Do you think that you pull all your money out of fossil fuels and they become the best performing part of the stock market? Interesting. You shouldn't support armaments and, you know, arms manufacturers, and many from a social ethical perspective would exclude it, but you know, those shares have done fairly well because of the war, not unexpectedly. Again, it's a short-term view, but you know, sure, if we're moving closer to World War III in whatever phase it is, maybe you can make a longer-term case for it, not ESG, but from an investment perspective. And then, you know, yeah, supporting Russia more generally and supporting, you know, how do you have that debate between kind of performance, returns, and kind of principle? Now, if you take a principled position, can stand with it, an individual investor or organization that has it as one of their founding principles, much easier. But for a general asset manager out there, an investment manager competing with the other best in the world, it's a really tough question. And we're going to ask this question of our managers, because I think these have highlighted the unintended consequences, have highlighted stuff you didn't have to think about, but now you certainly do.
Okay. The next question says, do you think a short to medium term bear market is happening?
I think that's unequivocal. I mean, I think that's unequivocal. You know, the size of the pullbacks is the case. I don't know, you know, it's interesting. COVID, remember when when COVID hit and the lockdowns happened in America and the markets fell, I can't remember the number, 20+%. I don't think that sell-off took place even a month before they flooded the system with money and cut interest rates and markets. That's the shortest bear market on history. So, you know, bear markets tend to be short and sharp. We've had a very short and sharp sell-off across the board. That means some of the risk has been taken out. That means valuations, or certainly prices, are a lot cheaper than they were. But I think it's a more difficult environment, and I think that's very healthy. I think it means quality will come through. An asset manager really has the ability to pick good stocks, will start to be found, whereas, you know, in the past, everything went up. Now, people, you know, some of my younger daughter's friends, you know, have played the NFT market and crypto and made a lot of money, and they thought they were very clever, but you know, all of a sudden they don't look so clever anymore. So I think in some ways it's good. It separates the men from the boys, so to speak. You know, it's a Warren Buffett comment of, you know, when the water goes out, you can see who's been swimming naked. And I think we can see a lot of naked bums out there.
So the next question reads, please provide your views regarding the short to medium term global inflation, global food inflation, and also indicate the possible returns levels to expect from developed markets, emerging markets, and asset classes if possible.
What did the second part was, the expected returns?
Yes.
So that's a great question. Again, you know, looking into the crystal ball is something that I try not to do. And I try to take longer term views rather than shorter term views. My thinking on inflation is that we have a real problem from a number of perspectives. Firstly, because we can't deal with it. America cannot deal with inflation. They're going to have to hope that it peaks quite quickly and comes down, because they have an inability to raise interest rates. We've got interest rates in America to 1%. You know, from 0 to 1 kind of story, and already the markets are tanking. You know, so I think the ability to get to 3.5%, which is already well below their current inflation rate, and even looking forward, you know, it falls to 4.5%, you'll still have negative real interest rates. So I think dealing with inflation in the West is a real problem. Supply chains are totally messed up now because of the war, etc. I think that could get worse. Again, I've got a very old car. I need to get another car. They're saying to me 12 to 18 months. You know, Glenn, you know, there's nothing we can do about it. Now that has huge implications across the board. And as I said earlier, there's going to be some stuff that might come out of Ukraine or may not be able to be shipped out of the Ukraine. You won't get it all. And so, but the other thing which is critical to inflation is expectations. And now I expect prices to be higher, and not just me, many people out there. And so you start buying ahead of it. And, so it builds in and of itself. You can see some of the, the wage increases that are being negotiated in South Africa and elsewhere to try and kind of deal with that a little bit, or try to be ahead of inflation. And so it's embedded in the system. So I think inflation is a real issue, and that does mean a more challenging environment for a while. However, the Fed has always cut rates when the markets fall more than 20%, and, they've only got 1% to cut. So, and they shouldn't be cutting because they say they're still going to be hiking, they'll be aggressive. Wow, they are having the most difficult meetings they've had in a long, long time.
We've got about 5 minutes left until the end. There is a question that's come in here. And the question says, does the extreme weather conditions and bird flu pose a risk to South Africa's agricultural exports in 2022? And will this risk be offset by the positive impact of other commodity exports, especially from the resource sector?
I think it's just an environment in which you already have this concern against sunflower oil and wheat and other stuff coming out of Ukraine, a major producer of that. And now we're starting to have bird flu picking up in the States and other parts of the world. And, it's an environment in which food inflation, which I didn't really answer a bit earlier, is already a problem. I think it remains a problem for a while longer. And maybe quite a while longer. When I'm listening to the commentators out there, they're saying these supply chain issues are here for a while. We're talking more like years rather than months. And obviously we don't know where the Ukraine war goes. God forbid, it expands and gets a lot worse. There's still some supplies in place. Again, one of the benefits China has is this huge amount of grain and other stuff it's bought because it needed to put its reserves somewhere. I think that's a very good and sensible strategic move. And others will be thinking kind of, in similar type of fashions. So, yeah, I think just difficult environment, inflation here for some period of time to come, and it's become embedded in expectations, which means it's around for longer.
And I suppose we can tie this question to your response. And also, you mentioned Thungela as well in your presentation. And from some of the local company releases, at least the ones I've looked at on Sense, they always mention, some of the issues with our rail system in order for us to be able to take advantage of that commodities boom, the fruit exports as well. And this is a question that's come in through here as well, saying, how do we look at that given our infrastructure challenges, at least from a rail export point of view?
So again, on everything, there's the one side and the other side, Darren. So the good news is that we've got opportunity, obviously, to do more infrastructure to spend. The president is pushing that message very strongly. It's a great pity that we had such a great Eskom and we were the cheapest electrical supply in the globe until very recently. We had a great rail system, great road system. Some of this has been allowed to be damaged, and that's a problem. It's a pity. And as you say, we've lost the benefit of that. We've lost the ability to take full advantage of the commodity cycle. And you're quite right. So many listed companies have highlighted those concerns. In that is opportunity to go and rebuild those as long as the money is available to do so, and as long as it is sensible spend. So it is a problem. I mean, in certain areas, the railways just simply don't exist anymore. I think rail traffic is down some 90%, and because of people stealing not just the tracks, but obviously copper wiring anywhere, and that's a very major spend. So actually, we are going to miss some of the benefit of that for sure, and that's a real pity.
Got a couple of minutes left. I'm going to squeeze in one question. We were talking about China as well and possible opportunities that may be there. To what extent does how the Chinese authorities respond to the COVID-19 situation in the short term become a key driver for markets?
Again, anything short term, is short term. I think well done for, highlighting that. I've been shocked at their response. I mean, I think, again, the response of other places, again, I'm flying to the UK and kind of, I don't need a pee. I don't need anything. I can just kind of, obviously they'll test me when I get there, they'll do some kind of screening. So I just don't really understand why they're doing it, because it's, it's not only very problematic for the economy, there's huge resentment that's built up locally against their own government taking such an authoritarian and such an aggressive stance. my gut is I wouldn't have done it. If I'm looking at it, and the Chinese Communist Party are very sensitive to kind of internal feelings, etc., which shocks me even more that they've done it. And I would have thought a decision to relax is sensible, and a decision to relax these restrictions would be very positive. And I think we would see a rally, and maybe a substantial rally, quite quickly.
Well, Glenn, it's been really great having you chat with us and share your insights, and would definitely love to have even more conversations with you, at least get your thinking in terms of how you see the next half of the year and how some of the events that you have highlighted in your presentation plan out. And whether we answer the question if peak oil is here or not, is it too easy, rather too soon to tell? We don't know. But thank you so much, Glenn Silverman, who, of course, is from RisCura, sharing with us his presentation, his insights. Thank you to those of you who've asked your questions. And unfortunately, we have to leave it there. Until next time, thank you so much for tuning in. Goodbye.
Thanks.